are options seller and companies are options buyer. If you buy a call on butter to a bank, so the bank here is obliged, if the butter price moves up, to give you butter at a given price. Maybe some of you say, but I don't understand, my bank does not produce butter. Yeah, sure, I will explain after that this kind of derivative is cleared through a cash settlement procedure and not a physical settlement. That is that, let me just give you an example. If you buy today a butter, a call, the right to buy the butter at 300 in 3 months, $300 per ton, for instance, 300, and that the spot price in 3 months of butter is 400, the bank will not give you butter at 300, but the bank will give the option buyer 100, which is the difference between 400, the spot market at expiration, and 300, the price fixed at the beginning. So you will receive as an option buyer 100, and you will buy your butter in a farm at 400. 400 minus 100 is 300. So in any case, you will buy at 300 and the bank will not give you butter. Okay, so it's what we call cash settlement. And then you have a 4 segment, which is a swap market. A swap is a contract by which you exchange flows with a counterpart. You can exchange variable rate against fixed rate. You can exchange for a commodity swap a fixed price against a variable price. And I explained, maybe I spoke about CDS, credit default swap. You pay every 6 months, for instance, 1% or 2% of the nominal value of a bond. And if the bond defaults, if the company which issued the bond default, you receive from the bank the nominal value of the bond. So it's like an insurance contract, but it's a financial asset. You can buy, you can sell. So I would like that just at this level, you know that you have 4 kinds of markets: spot market and 3 derivatives market, forward or futures, swap, and options. Which kind of assets do we buy? We can buy or sell on each of these markets: spot, futures, swap, options, either equities or interest rates, instruments like bonds, like bills, like many things. Currencies, you can buy and sell dollars against euro, against what you want, or commodities, you can buy and sell commodities. So each of these kind of assets, family of assets, equities, interest rate, currencies, commodity, are traded either on a spot market or on a derivatives market like futures, options, swap. Let me continue. Forward futures, that maybe explains the difference between the 2 kinds of market. That's, for instance, the screen on the Chicago Mercantile Exchange, where we trade a lot of commodities. Okay, it's the biggest market in the world. And here you quote the wheat, okay, futures price. Futures, because you will pay today, you will not pay. You will lock in today a price at which you will buy or sell in the future. And just I wanted to show you on the screen that the price of each expiration date, September, December, March 2022, December 2022, are not the same. And what is interesting for us, it's to explain the relation between these different prices, which is the futures price curve. And we will explain that in the future, maybe today or maybe during the last session. Okay. Then here in Europe, but also in Chicago, we trade butter on the futures market. You can buy and sell futures on the future market, butter. So as you see, August, September, October, November, December, the prices are not the same. Okay, so where is the difference? Maybe some of you know that the relation between the futures price and the spot price is what we call the cost of carry, but we will see that after. Okay, crude oil future. That's a quotation at the end of August. As you see, it's a strange thing here because the curve is inverted. If you buy oil, expiration date October, you will pay 63, you will lock in today a price of 63.92. November, 1 month later, it's just 63, but 63. Okay, it's lower. Then December, lower. January 2022, lower. You have an inverted oil price curve. Why? It's very interesting to know that. It's what I will explain after. Why is the oil price futures decreasing, inverted, as some economists say? Then some basic introduction. Could you just tell me if we spoke about cash and carry arbitrage or not? Just you tell me, you speak orally, you say, you put your micro and you say yes or not. Okay, not yet. Okay, not yet, but we will do that after. Okay. Thank you very much for people answering. Okay, to adjust an introduction. And today, what do we do today? Okay, there were some exercises. Okay, we did that. Oh, sorry. Okay. Today, what we will do is following. We have 4 segments of capital markets. Again, spot, futures and forward, options, swap. We will focus today about the spot market and not yet derivatives, spot. And in the spot markets family, we will focus about interest rates. And you know that you have a lot of interest rate markets, spot markets, short term, long term. And today we will see the connection between the short term interest rates and the long term interest rates. Long term interest rates are traded on the bond market. Everyone knows what is a bond, B-O-N-D. I will not explain what is a bond. But if you buy or sell a bond, you have an implied interest rate, what we call the yield, okay, which is the return when you buy a bond, if you hold it till maturity, etc. And you have short-term interest rates, which are decided, traded on the what we call the money market, the market on which banks lend and borrow between themselves money. I will explain that today. So today, my lesson is money, short-term and long-term interest rates, the connection between two. But before going to the connection, please, we go first to the money market, and then to the bond market, and then third part of the connection between the short-term interest rates, 1 month interest rates, and the long-term interest rates, 10 years interest rates, 30-year interest rates. The relation between all interest rates for single issuers, for instance, for the treasury, is called the yield curve. The yield curve. And frequently, I will come back about that. Frequently, we say that the yield curve is increasing. Let me just, okay, so let me just, no, Okay. I cannot find immediately the pen. Maybe here I can find something. Maybe. Okay. The yield curve normally, okay, here you have interest rates, interest rates. Here you have the maturity. I put M, maturity. And normally you have a curve which is like that. That is, which is increasing. The higher the maturity, the higher is the interest rate. Normally it's like that. Why? That's a very important question. And I will answer, and I will raise the question, and I expect an answer from you, and I will say, oh, I am not sure you're right. Okay, let me just. So you have an increase in yield curve with what we call a second derivative, which is negative, because it's not like that, the yield curve, like that, but it's like that. Okay, the slope is decreasing. Okay, so we will see where do we trade short term, where do we trade long term, and why is frequently the yield curve, why is it increasing? I will explain that. Okay, and I will ask you a question. Okay, have you some questions before I begin? And please don't hesitate to speak. Don't forget, I am in France, behind my computer, in my office. It's a sad room. Okay, I'm alone. So if you speak, if you tell me, okay, we don't understand anything, or we understand, that's very good. It's better than just writing. Writing is okay, sending message, but if you speak, it's better. Yeah? Okay, nobody wants to speak. Okay.
Yeah, I understand, Professor. I think that we can move forward.
Okay, fine. Okay. Let me just, and you will tell me, like Twee, you can speak. I appreciate. If you know that. In monetary economics, we have to distinguish, to make the distinction between two aggregates, monetary aggregates. What we call the monetary base, or the base money, and the money stock of money stock. That's very important, the difference. The base money is the money held by banks, essentially, on the central bank deposit account. Okay, all the banks, their bank is a central bank. You have maybe Vietcom Bank, or I don't know which. Okay, you, me, and companies have a deposit account in banks, commercial banks, investment banks. But the banks themselves have their deposit account at the central bank. And all the money held by banks at the central bank is called base money. That's very important. I don't want that you speak about, many people speak about liquidity. We say, whoa, there is a lot of liquidity in the world. It has no sense. We have to make the distinction between money held by banks at the central bank, and money held by companies, by households, by persons, and insurance companies in their banks. This money is called money stock, and money held by banks is called base money. And you have a relation, very important, between base money or monetary base, that's the same thing, monetary base or base money, and money stock. So base money is under the direct control of the central bank. That's the central bank which creates base money, okay? And that's small banks, not small banks, but banks, not the central bank, commercial banks, investment bank, who create money stock when they lend, for instance. I will see that quickly because I suppose you know that, okay? Just a question, if you can answer quickly. Do you know before the distinction between monetary base And money stock, is it very well known from you or not so well known? You can write if you don't want to speak. You can tell me we know very well, we don't know, we know a lot, we know. Yes. Okay. Let me just, people ask me to register. That's okay?
Thank you.
Okay, you're welcome. So if now banknotes and deposit accounts are very liquid, you can use this money at any time, okay? But if you add at this measure some accounts, you cannot immediately extract money, okay? Because it's saved during 3 months, 1 month, okay? You have another aggregate which is called M2. M2 is M1, that's banknotes and deposit accounts in banks, plus some saved accounts. Okay, so that's exactly that. And base money is money held by banks. Let me just ask you a question. You know probably accommodative monetary policy, which has been led, for instance, in United States, in Japan, in Euro. Since the subprime crisis, central banks deliver a lot of money. Okay, how does the central bank create base money? How do you know how the central bank creates base money, puts base money on the account of banks? How can they do that? Nobody? Okay, let me explain. Okay, that's basics of money creation, very important. We put on the left side, bottom left side, okay? I will try to put something, okay, here. Okay, you are here. Someone named X wants to borrow from its bank. You go to Vietcom Bank. Does it exist, Vietcom Bank? Does it exist? Because I speak a lot of Vietcom Bank.
It's a really large bank in Vietnam.
Oh, good. And do you have another bank? Because I will use 2 banks, Vietcom and another large bank.
BIDV, I think so.
BIDB.
BIDB.
Okay, I will call BIDB, and maybe you will understand when I speak about this bank. Okay. Okay. Imagine you, Tui, for instance, you go to the bank during the break of this course, this lesson, and you go to Vietcom Bank and you say, okay, I would like to borrow 100. Let me just tell $100 because, okay, you are in a US bank. Okay. Can the bank lend you 100 if the bank has not 100? The answer is yes. I don't have to have money to lend to a customer when I am a bank. That's really the power of money creation by bank. It's just an accounting writing. So you want 100? I put on your deposit account 100, and I put on the asset side of my balance sheet credit to 300. Immediately, the money stock has increased by 100. Now you have 100. You can use this 100 to buy something. Okay? So a bank does not use existing money to lend. I have been working a lot, as I told you yesterday, part-time, on a part-time basis in an investment bank in Suez. We did not have stores, okay? So just one big place, okay, with one, okay. And many customers borrowed from us. What do we do? Do you want 100? No problem. I put 100 of my liability side of my balance sheet. You can use them. And here I have a credit, an asset here of 100. So money creation, money stock increases when banks lend money. It's very important to understand that. But now I know that you say, but you borrow 100, the money stock has immediately increased by 100 because the bank gives you a credit. So the money stock increases by 100. But you say, oh, Mr. Marteau, I am 3. I want to use 10 on my 100 in terms of banknotes. I would like 10 banknotes on my credit of 100. So my deposit account will be 90 and I will get 10 of banknotes. Can the bank print banknotes? The answer is no. The bank cannot print banknotes. Cannot tell you, okay, I will give you banknotes, I will print myself. It's forbidden. The bank can create money. The bank cannot create banknotes. So you say, it's impossible what you are telling. I borrow, I ask for 10 in banknotes, and the bank cannot give me. Yes. Who is the only printer of banknotes? That's the central bank. The central bank is first the bank of banks. First role, economic role, I am the bank of banks. So every bank has an account at the central bank. So the bank one, if you borrow 100 and that you ask for 10 on the 100 in banknotes, will buy the banknotes at the central bank. So bank one will tell, okay, I will buy from you, central bank, 10 in terms of banknotes. The problem is that your account at the beginning is 0. You don't have money at the central bank at the beginning of So you have to borrow 10 for buying the banknotes. It's the reason why we have created what we call an open market segment in capital markets, an open market on which banks borrow to central bank first for buying banknotes. So when you lend 100, the change in credit, the amount of credit to the economy increases by 100. Sorry, okay, by 100. Sorry, it's difficult. Okay. And then this delta, which is a change in credit, is equal to the change in money stock. Because if TUI borrows from its bank on her deposit accounts, there will be 100. So she can buy shirts and shoes, iPhone, and what she wants, okay? Because she has money created by bank. Now she wants 10 in terms of banknotes. So if the credit moves up by 10, the money stock by 10, it creates a need for money basis. You have to borrow to the central bank 10. So if you create 100, you have a need for monetary base, MB, monetary base. Okay, that is, you have to borrow from the central bank, for instance, 10. Okay, so what happens? The central bank lends 10 to the bank one. Okay, I give you 10. I lend you 10. And I create here on the liability side 10 banknotes. Banknote, it's at the liability side of the central bank. every banknote created, again, except false banknotes, okay, banknotes created by people, all the official banknotes are on the liability side of the central bank. Because when a bank needs banknotes, she has to buy it from the central bank for first borrowing the corresponding amount, and then the bank here creates 10 of banknotes. The central bank gives the banknotes to the bank, and the bank gives to TUI the 10 she was asking for, and she receives 10. What happens here? TUI, her deposit account is now only 90 because she borrowed 100. She had a deposit account of 100. She asked for 10 in banknotes, so her deposit account is only 90, okay? And in fact, she has received the banknotes created by the central bank. So when you create money stock, you have a need for monetary base. And you have also something that is what we call required reserves. Required reserves. Sorry, because required, R-E-U-U-I-O. I'm not very good when I write. Required, okay? Reserves, which are, for instance, in the Eurozone of 1% of the deposits in the banks. So Bank One here, TUI has a deposit account of 90 now, 90. Bank One is obliged to have a deposit here at the central bank in its bank of 1% of 90, okay, which is 0.9. And as the bank has not at the beginning 0.9, she's obliged to borrow on the open market to the central bank 0.9, okay, and here for required reserves. So what happens? If you lend 100, you have a need for monetary base, you will borrow from the central bank 10 for banknotes plus 0.9 for required reserves. That's 10.9. And if you understand that, you say, maybe I will use, I will write, I would like to make a test, but I am not sure it will be good because let me just try to do something. I'm not sure it's okay. Okay, do you hear me here or not? Okay. I hope you hear me because I don't hear you. And I cannot see here the message. So can TUI or someone else tell me, yes, we hear you? No, you don't hear me? So I will stop here. Okay. Okay. So I will try to. Okay, I can. Okay, let me just. Okay. So, do you hear me? Sorry for asking you every minute. Do you hear me? But it's okay. Message. Yeah. Okay. Yes, sir. Fine. Okay. You don't see me, but you know that I am a sir and not a lady. Good. Fine. Tan Chung Tan. Very good. Okay, let me just. Okay. So you lent. Okay, you lent. Whoa. You lent. I'm not sure that it's better. You lent 100. Okay, you have a need of monetary base of 10. Okay, no, I cannot write with that. Okay, of 10 plus required reserve 09. Now, if we make a small, very easy mathematics, that means that if you lend 100, the money stock moves up by 100. But it requires monetary base equal to B, where B is a ratio between banknotes and money stock. That is 10% in my example. So if you lend 100, you have to borrow from the central bank 10, which is B is 10% times 100, plus what we call the required reserve ratio, which is 1% here in the Eurozone, which is slightly higher in the US at the Federal Reserve Bank, but it's close to 2%, not a lot, okay? And here it's on the deposit, and deposits are 1 minus B, that's 90% in my example, times 100, times monetary mass, times money stock, okay? So basis here, what you borrow from the central bank is B, which is a ratio between banknotes and money stock, times 100, plus required reserves on deposits, and deposits are 100 times 90% because banknotes are no more in deposit accounts, okay? And that's if you put 100 or M, which is a money stock created, M in factors, you obtain this essential equation for understanding the monetary policy everywhere in the world, Japan, US, Eurozone, probably Vietnam, which is, okay, money stock, that's money that companies and household hold in their deposit account in banks, is equal to base money, that's money held by banks at the central bank, divided by B plus R minus R times B. That's very close to 10% here, 10%. What does that mean? That means that the money stock, money held by people and companies in the banks, is quite 10 times, because 1 divided by 10% is 10 times money held by banks at the central bank. That's very important. If you have to be clear with one equation in this lesson, it's this equation. It's the money held by people and companies in the banks is money held by banks at the central bank divided by around 10%. It's B plus R minus RB, where B is a ratio banknotes divided by money stock, and R is what we call in monetary policy the required reserve, which is reserves divided by deposits. So globally, you should have a money stock which is 10 times equal to the base money. And that's very important. Why? Because governors of central banks, presidents of central banks say, I have a way, it's very easy to stimulate the economy. To stimulate the economy, I have to increase the money stock, the money held by people and companies in their deposit account of banks. How can I do? I am the executive, the treasury. I cannot. Yes, I can give money directly to people, but in fact, I cannot lend money. If I lend money, you create money stock, and I am the treasury. I cannot do that. Only bank. But I know that money stock is equal to 10 times base money, and myself as central bank executive, I can give banks base money. How can I give base money to banks? Let me just tell you. If you borrow 100, you need from the central bank 10. If the central bank gives you 100, you can lend 1,000 because the ratio between money stock and base money is 10. If the central bank, the Federal Reserve Bank of New York, lends bank maybe $1 billion, not million, billion, banks can create $10 billion money stock, and the economy moves up. You understand that? That's very important. I would like an answer from you. How can the central bank, the Federal Reserve Bank, the European Central Bank, probably the Vietnamese Central Bank, how can it create base money in order to stimulate money stock? How can the central bank gives base money, monetary base to banks? Please tell me how it's monetary policy. How can the central bank gives base money, create monetary base? You can answer by message if you don't want. T2 Hin Nguyen is writing, issue government bond. Oh. Are you sure? Are you sure? Before answering, and thank you a lot for answering, T2 Hin Nguyen, I will maybe wait for other answers. And after I will tell you if issue government bond is a good way for creating base money. Issue treasury bond. Okay, yes, that's the same thing that government bonds, treasury bond or government bond. I understand. Okay. Some of you are writing, okay? So I will wait. Okay. To issue. Okay, no other answer. Let me just try to, sorry. Okay. Let me answer. You have two ways for creating base money. What is creating base money or monetary base? Okay, just base money is equal to monetary base. It's exactly the money held by banks at the central bank. Okay, so I am sure that Vietcom Bank has money at the Central Bank of Vietnam. It has a deposit account with a lot of money. This money is base money. And your money in Vietcom Bank is money stock. But if you want money stock by borrowing, the Vietcom Bank will be obliged, because banknotes, etc., require reserve, to borrow, and so to have on a deposit account around 10% of what you are borrowing, that is from the money stock. So, and you understand now that if you want to create money stock, you have to create base money at the central bank. How can you do? What we call the quantitative easing. I hope you know about quantitative easing. Wait, yes, that's okay, quantitative easing? Or that's not okay? Each time I have someone is writing, but I don't see anything. Okay, I don't know why. Maybe. Okay, okay. Promoting citizens to put deposits in the commercial bank. Quantitative easing. Yes, quantitative, like quantitative easing. E. Impossible to write with a mouse. Easing. Quantitative easing. Okay, that is, state bank will sell or buy bank to consumer supply in the economy. Yes, that's not bad. That okay. The central bank will buy bonds and credit to banks from banks. That is, the Federal Reserve Bank of New York in November 2008, at the beginning of the subprime crisis, decided to buy from banks credits, subprime credits. I buy from you your subprime credits and bonds, treasury bonds. They held on their asset side of their liability. So if you have a bank here, okay, let me show you. Difficult. Let me just, okay, again. Okay, you are Vietcom Bank, VB. VB is Vietcom Bank. Here you have the Central Bank of Vietnam, Central Bank, CB, Central Bank. What is OMO? Sorry, Thu Hinh Nguyen. What is OMO? Okay, I understand. Someone is writing quantitative easing is when central banks buy bonds from banks. Absolutely right. To lower the interest rates on saving and loans. That's also very good, because the consequence of buying bonds is that the price of the bonds move up. And if the price of bond moves up, interest rates move down. That helps to keep inflation low and stable. That's a very good answer. And I would like that everyone, each of you, is exactly as the answer which has been given, which is outstanding. Okay, so everybody understand. I will just come back on what your colleague write. Quantitative easing is when central bank buy bonds to lower interest rates. Yes, to create monetary base, to lower interest rates, and that helps us to keep inflation low and stable. That's marvelous. That's a very good answer. Let me come back. I will illustrate what your colleague is writing. Here you have Vietcom Bank, a large bank in Vietnam. And this bank, on the asset side, has credits, because the role of a bank is to give credit. So here you have credit. And it has also bonds, assets. And among the assets, it has bonds. And among the bonds, it has treasury bond. That's bond issued by the government to finance its expenses. Okay, so at the beginning, you have the Vietcom Bank. Vietcom Bank has on its asset side balance sheet credits and bonds. And here on the asset side, you have your deposit accounts at the Central Bank of Vietnam. So here you have something. Okay. Imagine that your account here you have Vietcom Bank, which has on the liability side of the central bank, you have the deposit account of banks, which is on the liability side. For banks, cash they have at the central bank is on the asset side. Okay. So here, imagine you have zero. Vietcom Bank has no cash in its bank. And so here you have zero. Okay. So if you have zero here, central banks say if you have zero, it's difficult to lend, because if you lend, you have to get 10% of what you are lending. Okay. You can borrow, but it's better if you have money. So the monetary policy in United States, in Japan, in the Eurozone has been, I will create monetary base. How can I do that? One way is quantitative easing. Quantitative easing is exactly what your colleague said. When central banks buy bonds, I stop here. Central Bank of Vietnam, for instance, buy bonds to Vietcom banks. It tells Vietcom Bank, okay, I buy from you 100 million of treasury bond. Give me this bond. You give this bond, oof. Vietcom Bank gives the bond, and the bond here, which are issued by the Vietnamese government, here, T bonds, treasury bonds, are now here for 100. But when the Central Bank of Vietnam buys bond from the Central Bank buy bond from Vietcom Bank, it creates here monetary base because the deposit account of Vietcom Bank at the Central Bank moves up by 100, normal. So here you have 100 bonds less, lower, but you have here your account at the Central Bank, which is 100. So when the Central Bank buys bonds from banks, commercial banks, or investment banks, it creates monetary base, it creates money for banks. And as I told you with this outstanding equation, if you create 100 of base money, how can the Vietcom Bank lend now 1,000 if everyone has understood? Because to lend 1,000, when you are a bank, you just need 100. And you have 100 because the bank bought from you that. You understand that? So the way for fighting the economic crisis, first subprime crisis, after we will see the pandemic crisis, one way used by central bank is in fact to buy bonds or credits from banks and to create monetary base. And we say if banks have monetary base, they can lend 10 times what they have. Because my equation here, and we explain why, is money stock equal base money divided by 10%. During the subprime crisis, the Federal Reserve Bank of New York bought around 50% treasury bond and 50% subprime credits. So all the banks in the United States who held subprime crisis, the junk crisis, bad credits, could sell them to the Fed, and the Fed bought these credits. Okay, so the credits were here. It's the reason why some economists said the Federal Reserve Bank of New York is becoming a bad bank because at its on its asset side it has subprime crisis. Yes, it has treasury bond, which has good quality, but it has 50% of credits. You know, that's exactly what happens. And for people who don't understand me, let me just now show you US case. Look, I hope you understand that now. That's Fred is the Federal Reserve Bank of St. Louis, and here is monetary base. You know, that's a document extracted from the Federal Reserve Bank, so an official document giving you the evolution, the behavior of the monetary base in United States. It's very important. What is monetary base? I already said that 20 times, but again, 21, it's money held by banks at the central bank. And how can you create monetary base? By buying, for instance, credits or treasury bonds held by bank. You buy from banks. You tell Vietcom banks, I buy from you your bonds, your credit, your equities. What happens? We are here. I don't know if you see. Okay, we are in November 08. I remind you, probably here we are closer to these events, but so we know that very well. It was in November 08, the first quantitative easing step during the subprime crisis. Look at, I don't know if you see that. Here, the monetary base in November was 800 billion, 800, okay, billion dollars here in November 08. What did the Fed do? In November 08, it decided to buy, look at, to buy 800 bonds and credits from 800 to 1,600 billion dollars. It what, for people who know that, we call QE1, quantitative easing 1. First step, I buy. It's a crisis, subprime crisis. I want to stimulate the economy. I want that the bank lend money. Or as I know that when a bank lends 100, it has to have 10 on its deposit account at the Fed. I will give $800 billion by buying bonds from banks. And I hope you understood, if I give banks 800 monetary base, that deposit account, they can lend how much? They can lend 8,000, 10 times, billion dollars. Money stocks normally should move up 10 times because I know my equation between money stock and monetary base. And then here you have the second quantitative easing action, what we call QE2. And the monetary base comes from $1,200 billion to around, I cannot see, but it's a lot, okay? It's around 1,000 billion. And then you have QE3. Whoa! You know, between November 08 and 2014, which is the end of the quantitative easing program of the Federal Reserve Bank before the pandemic crisis, okay, the monetary base has been multiplied by 5 from 800 billions here at the beginning to around 4,000 billion dollars. So normally, if this monetary policy, accommodative monetary policy, would work, normally the money stock would have increased by 10 times this huge amount, and the economy is very good. The growth rate is now 35%. But in reality, the money stock did not increase a lot. And why? Let me just come back to another. In fact, the causality between money stock and monetary base in just one way. If the money stock increases through credits given by banks, do you remember at the beginning of the course, Tui, who is the only woman speaking here, and I hope that many of you speak, okay, she tells, okay, we took the example, she borrows 100 from Vietcom Bank. So the money stocks moves up by 100. The monetary base has increased by 10 because for lending 100 to TUI, I need 10. And as I know this 10, I must borrow them and my deposit account is increases by 10. But so that's a causality. But if the monetary base increases, the bank buy bonds from banks, it's not sure that the money stock will increase. I am sure that if TUI borrows 100, the monetary base will move up by 10. I am sure. That's mechanical. But if I give 10 to the bank, monetary base, I am the central bank, I am not sure the Vietcombank will lend 100 because maybe TUI does not want to borrow because she has no need for borrowing. So this causality in monetary policy is just one way. If you create money, the monetary base will increase. But if the central bank gives monetary base, it's not sure that the money stock will increase. If no demand for credits, bank withhold a huge amount of monetary base. They will not use. And the after question is, what do the bank do with this huge amount of monetary base? Okay, let me just come back. Maybe something like that. Okay, so that's quantitative easing, monetary policy, what we call accommodative monetary policy. In Japan, same thing. In Eurozone, same thing. Central banks bought bonds and credits from commercial banks and created a huge amount of money. When we say there are billions of dollars in the economy, be careful. That's not true. There are a lot of billions of dollars on the deposit account of banks at the central bank, not in the economy, not in deposit account of companies or household. This money is given to banks, not to people. Okay, so here you have, okay, we're from 800 till around 4,000. It's time 5. Okay, and quantitative easing monetary policy has been stopped in 2014. Okay, and as you know, the monetary base in banks was stable and even slightly decreasing. So now you ask, okay, did it work? Did the monetary policy in the Eurozone, in Japan? In Japan, you know the answer, it's no. In United States, how is the money stock? Let me just show you. Oh. The monetary base moved up a lot. Money given to banks. The money stock, money in the deposit account of you, of me, of companies, increased really slightly, poorly. So what happened? If you are a trader in a bank, you receive a lot of monetary base on your account. And no people are borrowing. So you don't use this monetary base. What do you do with the stock of money? Please answer. What do you do? What do banks do in the United States, in Japan, in Eurozone? I cannot say in Vietnam because I don't know really the Vietnam case, but in the United States, in Eurozone, in Japan, what did the trader, the 25 years old trader, what did they do with this huge amount of monetary base? Please tell me. You speak or you write me. Oh, immediately something is right. To invest into financial markets. But Thi Phong Anh Ly is very good. Maybe it's she or he. Are you a lady or a guy? A lady? I'm lady. Okay. She Okay, maybe she's working as a trader in a bank because she knows that very well. I give you a lot of $1 billion monetary base, and nobody is borrowing. What do I do with this money? Sorry? I'm so happy to hear your voice. Yes, please. Keep on. What do you do? Oh, someone is. I cannot understand. Can you speak? No, nobody wants to speak. Yes? Oh, no. Okay, so I don't know how to turn on my voice. Okay. Normally you have a small picture with a microphone. I don't know how you can do. Maybe your colleagues can explain how you can put your micro on in order to speak.
Hello, sir.
Yes.
Yes, I think for the bank or for the investment institution, when they have a huge of cash on hand, they will invest in the financial market, like stock or something like that.
Perfect. Really? You will get an outstanding grade.
That's why I can see that during the QE period, the stock market increased a lot in US and even in around the world like Vietnam.
Okay, I ask me, but why do I teach? What you are telling is very good. Is everybody know that? Okay, maybe I do something else because that's very good what you are telling. Okay, so seriously, what you say banks had a lot of cash. Yes, I would prefer have a lot of monetary base, but that's cash because monetary base is cash held by banks at the central bank. You are right. Okay, what do they do? When you are 25 years old and you are a trader in a trading room in New York, that you have a huge amount of cash, in order to speak as you buy assets. Which kind of assets? You told me stock, right? Bonds also, a lot of treasury bonds and corporate bonds also, maybe commodities also. So what happens? It's very strange. During the two crises, the subprime crisis and the pandemic crisis, as you told me, you told us, the stock index increases a lot. In United States, they have their top level during the crisis. Why? Because the Federal Reserve Bank created a lot of monetary base. So the 25 years old traders bought stocks, bought bonds, and the price of financial assets moved up a lot. But now, some of you, which was T2, Yin, and Nguyen, told us buy bonds to lower the interest rates on saving and loans. Another consequence of that is that the central bank bought bonds, gave monetary base, and with monetary banks bought bonds, and they sold bank to central bank, etc. What happens? The price of bonds moved up a lot. And as you know, because you are experts now, when the bond prices moves up, the level of interest rates move down. And the guy here, or the lady, I don't know, T2, Hin, and Nguyen, told us to lower the interest rates on saving and loans, on everything, on bonds. Okay? So when you buy bond, the level of interest rates move down. And what do you, that's very strange for each of you who made probably studies in economics. That's not strange that the need for borrowing of treasuries increases a lot since the subprime crisis. but the level of interest rate decrease. That's so strange. You borrow a lot, and as you borrow a lot, the level of interest rate decreases. Why? Just because we gave banks billion of of monetary base, and that the 25 years old traders bought stocks, bonds, commodities. You know, maybe you remember in 2010, there was a big problem with less developed countries on the price of wheat and on cereals. And we said that that it was the responsibility of the accommodative monetary policy who gave a lot of cash to banks who bought commodities and who were responsible of the increase of the wheat price, which was really very, very bad from these less developed countries. So that's probably right. That's probably partially right. When you have money, you buy something. So it's what we call a bubble. Bubble. Okay, I write bubble because I like to write bubble. Bubble. Oh, lo, 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 that's so. Okay, sorry. I don't know. Okay, bubble. Bubble, bubble, bubble. That's better with my mouse. Bubble. Speculative bubble. That is, the price of the assets moved up, not because the value of the asset moved up, because banks had a lot of cash. I don't know how to turn my okay. So, do you have other question about that? Just I remind you that that's a good news for you. In 10 minutes, we make a break. Good news, no? And for my voice, because this week I have a lot of lessons in different institutions, ESCP, Sorbonne, and the best one, Vietnamese students. So I speak a lot, and at the end, and tomorrow I have in a French company accounts and conference on monetary policy. So my voice, I don't know what to say. So in 10 minutes, 9 minutes now, as I propose you, I will take a tea because I love tea. Okay, Vietnamese tea is very good. When I come to Vietnam, I buy a lot of tea, but now I cannot go to Vietnam. Okay, maybe next year. Okay, maybe for people who fail the exam. Okay, you will fail the exam. So you will say, okay, we failed the exam. We have to get another course. And Professor Marteau has to come to Vietnam. We can come now. No more pandemic crisis. And I come with my wife, which is from Vietnam, 50%. And I spent marvelous day there. So, okay. It was just for... okay. So, you know what happens. So, what is very important is to be clear with the difference between money stock and monetary base. You know, it's the reason why at the beginning of my lesson this afternoon, I told you you have two monetary aggregates. You have to make the distinction. Monetary base, money held by banks, money stock, money held by companies and households. Okay. I don't know why it's okay. Okay. So here, sorry, because I don't know how to put. Do you see the picture good or just a partial? Have you just a partial view of the slide? Because here in France on my screen, I have just around 50% of my slide. The remaining is black. That's so strange. It's okay for you or not? Discussion. I can see just a part. Thank you. Okay, maybe during the break I will try to. I don't know why. Okay, so here it's what we call the multiplier, which is a ratio between money stock and base money or monetary base. You know, till oh yeah, okay, I understand. It's very difficult. Let me just. Wow, that's not better. That's not better. Well, okay, I will see that after. Okay, so here you have the ratio M money stock divided by B. You remember in my expose the equation I told you that it was around 10. Okay, monetary base is around 10% of money stock. And before the subprime crisis, because here you have 2008, okay? Before you have something close to 10. As I told you, the required reserve is in United States is closer to 2%. So it's slightly B plus R minus RB is slightly higher than 10%. So the ratio between money stock and monetary base is slightly lower than 10. And as you say, you are around 9. We are very happy with that because we understand why. And then central bank gives a lot of monetary base by buying bonds and credits from banks. What happens? As the money stock does not increase, the monetary base increases a lot. The ratio between money stock and monetary base moves down till around 3 today. Okay? Just easy to understand. Okay. I am really obliged to look at what happens, but maybe what I propose you just because I cannot know immediately. Maybe does one of you know how I can make my slide not?
Can you stop sharing and then sharing again?
Sorry.
Can you stop sharing the materials and then you sharing again?
Yes. So we make the break now. It's what we want to say, to tell.
Yeah.
Yes. Okay. We make a break now.
Yeah, please. Thank you.
So we make a break now, 15 minutes, and okay, and we come back in 15 minutes. Okay. And I try to put better. Thank you. See you in 15 minutes. Okay. So I give you 2 minutes for the first question. Second question, what is the risk with the balance sheet of central banks multiplied by 5 in US and Eurozone? I would be interested, but maybe it would be interesting for you to look at what happened in Vietnam. Is it the same thing, accommodative monetary policy? Because in the US and in Euro and in Japan, the central bank, its balance sheet has been multiplied by roughly 5. Why? Because these banks, these central banks, bought a lot of assets from banks, created monetary base so that the balance sheet, asset side and liability side, moved up, has been multiplied by 5. My question is it a problem that the balance sheet of a central bank is multiplied by 5 in some years? Third question, why are interest rates on sovereign bond in Germany, on Bund, German sovereign bond, treasury bond, are negative. Why? Okay, so I give you 2 minutes for each question, and my hope is that you, my best hope is that you answer by speaking. But if you don't want to speak, you can send me your answer by message. Okay, so I give you 5 minutes, 5 for the 3 questions, and I wait for your message with the answers. And after, if you want to speak, that's better. Okay, so 5 minutes for these 3 questions. Maybe I stop immediately for the first question because I have an outstanding answer here. It's written from nowhere. From where does the base money created by banks come from? The answer which is given is from nowhere. That's perfect. I cannot say better. But a lot of people think it comes from somewhere. Okay, no, it's just an accounting operation. When the central bank buys bonds, on its asset side of the balance sheet, it writes bonds, both, and on the liability side, it creates base money given to banks. So the answer given by your colleague is perfect. From nowhere, he writes or she writes, because the central bank has a privilege to create the base money. Sure, that's someone who has very well understood. Without any requirement, you are absolutely right. As long as they can control the money supply, inflation rate, to growth, the economic well, yes, okay, as long as you are right. But you can stop at the beginning. Okay, so from nowhere, because the central bank has a privilege to create the base money without any requirement, you are perfect. So that's a very good answer. I would be happy if everyone, each of you, has answered in the same way. Okay, perfect. So now you can go to the second question. What is the risk with the balance sheet of central banks multiplied by 5 in US, Eurozone, Japan? I don't know. I would be very curious about Vietnam because, sorry, I don't know the Vietnamese monetary policy, but I would be very happy to see the pictures with money base money and money stock. Do we have the same disconnection between monetary base and money stock? Is the ratio between 12 at the beginning and 3 now? Okay, it would be interesting. But before, please answer the second question. What is the risk? Okay, is it a problem? Okay, as your colleagues say, the base money created by the central bank comes from nowhere. It's just accounting operation. So is it a problem that the balance sheet is multiplied by 5? If you look for a company, it would be maybe a problem. We don't understand. For a central bank, is it a problem? Where is the problem? Okay, 3 minutes more. 3 minutes. And someone answered, I would like that you answered also, the same person or another person. What is the risk with the balance sheet of central banks multiplied by 5 in the US and Eurozone, for instance? I don't know in Vietnam. If you know, if someone is working with a central bank, I would be curious to know if the size of the balance sheet of the central bank of Vietnam has also multiplied by 5. If they have implemented an accommodative monetary policy with quantitative easing. I don't know. I would be really very happy with the information. Three minutes. Okay, I got two answers. Too much money without improving productivity should create inflation. Second answer means central bank bought a lot of bad debt bonds from commercial banks. It may depreciate the country's currency value. Okay. Normally, what economists say about this problem is that it could first create inflation. Why? Because on the asset side of the central bank, there are a lot of assets bought from banks, treasury bonds, credits. One of you said central bank bought a lot of bad debt, bad bonds. That's partly true in United States when they bought subprime credits, 50% of what they bought. But that's not true, for instance, in the Eurozone. The central bank, European Central Bank, did not buy bad bonds or bad credit. It bought essentially, I would say, 90% of treasury bonds from the different countries of the Eurozone, German bonds, French bonds, Italian bonds, etc., Spanish bonds. So I don't think that the answer bought a lot of bad bonds is true for every central bank, probably for Fed, but that's not really the more important answer. The more important answer, it can depreciate the country's currency value. That's not bad. That's a good answer also. But I would say that the best answer would be inflation. Why? So as I told you 1 minute ago, you have on the asset side a lot of assets bought from banks, not necessarily bad assets. If you look again at European Central Bank balance sheet, you can get it on internet, you will see that the central bank has essentially treasury bonds, and from good quality, German bonds, French bonds, etc. So, but on the liability side of the central bank balance sheet, you have base money. That is, you have the deposit account of banks. And don't forget something. Before sleeping, don't forget this equation. You have a ratio between money stock and base money, which could be 10. Because if you want to lend 100, you just need 10. So if I take the example of the European Central Bank, you have something like $6,000 billion on the liability side. So the banks could lend 10 times this amount. And if the bank decided to lend 10 times what they have at the central bank, you can be sure that you will get inflation, because the growth of the economic activity cannot immediately improve. So you will have a huge quantity of money stock this time, no more base money, but money stock. And you have, like Fisher equations as explained, a relation between money stock and inflation, which is a theory, the quantitative theory of money. So a lot of economists say, be careful, because this huge quantity of base money could one day, maybe not in the coming months, but maybe in 2 years, be changed in money stock with a ratio which is 10 times. And it could be inflation as a counterpart. So that's really the explanation. The former president of the Federal Reserve Bank in the United States, Janet Yellen, said, if we keep our bonds on the asset side, our assets, so with a huge quantity of base money, we have an inflation risk. I explained that 1 second ago. But she said, to reduce the quantity of base money we have as a central bank on our liability side, we have to sell the bonds we bought. We have to sell, because if you sell a bond, you are a central bank, you sell partly your bonds. So if you sell to the banks, the deposit accounts of banks at the central bank will be reduced, and the risk of inflation will be reduced. Yes, but Janet Yellen, the former president of the Fed, said if the central bank begins to sell its bonds, the risk is a bond crash. That is, the price of bond moves down a lot, interest rates move up a lot, and it's the bond crisis. So it's very difficult. Either you keep your assets if you are the central bank and you have an inflation risk, either you begin to sell your bonds and you have a crash, a bond crash risk. So stopping quantitative easing is a very, very hard task. It's what we call in our language tapering, Tapering, tapering. Tapering is reducing the balance sheet, reducing buying bonds from banks. And that's very difficult. Today, there is, as you know, probably some of you, a big discussion in the United States about what the central bank, the Fed, should do. Tapering, that is beginning to sell its bonds, or to keep them. And if you keep them, you have an inflation risk. So, okay, what is the risk with the balance sheet of central bank will buy by 5? It's inflation or crash. So the situation is not so easy. Okay, so someone said it may depreciate the country's currency value. Sure, at the second step, not first step, but at second step, if you have a crash of the bond, US bond markets, surely you will get a problem of the dollar. Okay. And about central bank bought a lot of bad bonds. That's true. That's not bad, but it's essentially in the United States, not in the Eurozone. The European Central Bank has not bad bonds or bad credits. Fine. I give you 3 minutes now to this last question. Why are interest rates on sovereign bond in Germany and France also negative? Please, you think about 3 minutes, you give me an answer, and when I receive answer, I come back. Okay? Well, I am here, but I answer. Okay? So please answer or speak. Why are interest rates on sovereign bond in Germany and France negative? Okay, just received an outstanding answer again. Very good answer. I let you 2 minutes more for people who are not so experts, but I got a very good answer already. So I must make my lesson more difficult because you seem to be very good. Maybe I will do something more complex. Okay, I give you 2 minutes more. Okay, I will give you the answer. Okay, I got an answer which is absolutely good. Okay, as exactly for same for the first question, and really you are very good. I am I don't know if it's a lady or a man, so I don't know. The person writes, it means that central bank. Sorry, yes, someone is writing. Maybe I will wait for the last answer. Just wait. Okay, so the answer which is given is it means that central bank, which means that central bank charges commercial bank keeping. Oops, sorry, because I don't see keeping on keeping the deposit. That is, in fact, it's written that the interest rates on deposits given by banks to the central bank is negative. The remuneration, the interest rate is negative. It should be a motivation for commercial bank to lend their money to individual or corporate instead of keeping it. That's exactly what happened. For instance, in the Eurozone, Mario Draghi, which was a former president of the European Central Bank, the present prime minister of Italy, said, I would like that this base money, because he was very good in monetary economics, he was a professor, he was very good. He said, he did not say liquidity, he said base money. I'm not sure. I love Christine Lagarde, but I am not sure that she says base money and maybe she says liquidity. Okay, so we don't know what is liquidity. So Mario Draghi said, but she is a very good president of European Central Bank. But okay, because I am working at the Bank of France. So and I have been working with Christine Lagarde when she was the Minister of Finance. So it's the reason why I love her. But she's not so expert as Mario Draghi in economics. And Mario Draghi said, I would like that monetary base is not kept by banks and the central bank, but used for lending. And it's the reason why I will put a negative interest rate on deposits held by bank at the central bank. And probably you don't know, maybe some of you know, but globally, that the interest rates on deposits held by banks on their central bank account is minus 0.5%. Minus 0.5%. That is that if you have on your on your central bank account, if you are a bank, you have 100. At the end, if you don't use your 100, you will get 99.5. instead of 100. So if you are working in a trading room, you are again 25 years old, well educated, and we say, okay, if I keep my monetary base on my deposit account as a central bank, I will get a return of minus 0.5%. You say, I prefer to buy assets, risk-free assets, not risky assets, but risk-free assets, which have a higher return. But a higher return can be negative. You can prefer to have German bonds or French bonds with a yield of minus 0.49, minus, you prefer 0.49% on a Bund, German bond, rather than minus 0.5 on your deposit account. It's the only reason why the interest rates are negative on the bonds, French bonds, and German bonds, not on Italian bonds, not on Greek bonds, not on Spanish bonds. Why? Because 25 years old traders prefer to buy, to substitute their deposit account at the central bank minus 0.5 against a risk-free asset with, for instance, minus 0.49. Because if you buy, instead of your deposit account, if you buy Italian bonds, which are risky, it's not good. You want an asset to substitute two assets within the same class of risk. And the central bank is risk-free, the deposit, and buying German bonds is also quite risk-free. Okay? So if you look at the US bonds, the US Treasury bonds, the yield on US Treasury bonds is never and has never been negative. Why? Because the interest rates on deposits of US bank at the Fed is positive. When a bank has a deposit account at the central bank which is positive, you have money, you have base money, you have an interest rate which is positive. So you will not buy bonds with negative interest rates. So it's really only in cases in countries where the deposit facility interest rate, what we call deposit facility interest rate, so to deposit the interest rate on the deposit account at the central bank is negative. Okay, so and someone is reading an article. Okay, I will read it after, and my advice is to you read also, because I think that's a good recommendation given by your colleague. I will read that after. Okay, okay. I will just show you. If I find that. Oh, yes. Look at key interest rates in the Eurozone, August 21. As you see, deposit facility, that is the interest rate on deposit account at the central bank, is since 2019, September, so that is exactly 2 years, minus 0.5. And if you have minus 0.5, it's exactly as if I told you I would like to stimulate the Vietnamese economy. And now I put negative interest rates on your deposits in the bank, not on the monetary base, on the money stock, because you have money stock. I have money stock. Companies have money stock. And I decide, I am the president of the Central Bank of Vietnam. I say, on all the deposit accounts in banks, you will get an interest rate, you are very happy, of minus 10%. Oh, what do? Probably you buy assets, risk-free assets instead of keeping your deposit in your bank, because now you have -10. So you will choose liquid asset and risk-free asset. Which kind of assets? Probably treasury bond. I don't know if the Vietnamese treasury bond is risk-free, but okay, you will get risk-free. So, and you will be able to buy bond with a negative interest rate till -9.9%, because you prefer -9.9 to 10 to -10. So that's exactly. And you see, since it's a long time since in euro 2013, it's 8 years. The interest rates on deposit accounts in central bank, in the European Central Bank, is negative. So, okay, the effect is just that interest rates are negative. So, I have a question here, which is more political. In fact, who is very happy with negative interest rates? First, the Treasury. Treasury is very happy, because when it issues bonds, for instance, nominal value 100, it will receive and reimburse in 10 years 100. If the yield is negative, that means that investors will buy this bond higher than 100, maybe 101, 102, to receive in 10 years only 100. And the yield can be negative. So the Treasury is very happy. He borrows money from investors. He receives more than 100, more than the nominal value. He pays it coupons. At the end, he reimburses 100 only. And the yield can be negative. So the Treasury is very happy. But in the Eurozone regulation, normally you have an independency between the central bank and the government. I'm not sure, because these negative interest rates on deposit of banks at the central bank makes the political governments very happy with negative interest rates. That is the first consequence. The second consequence of questions is be careful, because in the Eurozone, a lot of institutional investors, like insurance companies, like funds, pension funds, some companies say, okay, investing with negative interest rates is really bad for us. I am an insurance company, and I have on my liability side money to give to some investors, for instance, and the money they give me, I invest it with a negative interest rate. I cannot give them positive interest rates, and I am engaged to pay positive interest rate. So what do I do if I am an insurance company? I will try to find risky assets with a higher yield, a higher interest rate that treasury bond interest rate. And we observe here in the Eurozone, we observe that the portfolio of institutional investors are more risky than the previous years. Investors are looking for risk, because risk gives you higher return. If you don't take any risk, you have a negative interest rate. So, from my point of view, it's very dangerous, because a lot of institutional investors have risky portfolio. And if big company defaults or something like that, I think that all the people will sell the risky bonds, and you will get a crash, a bond crash. So be careful with that. it seems very good to have negative interest rates, but essentially for the issuer, for the guy who is borrower, it's probably, but for investors, it's very bad, and it can go to conduct to risky portfolio. Be careful with that. Okay. So I come back. Oh, I am happy to find that. Exactly the question I raised. That was Janet Yellen, former president of the Fed. Excessive inflationary pressure could arise if assets were sold too slowly. So exactly my question. If you keep your balance sheet 5 times its size some years ago, you have an inflation risk that the monetary base is changed in money stock. But if you decide to reduce the size of your balance sheet, you are a central bank. Financial market and the economy could be destabilized if assets were sold too aggressively. If the central bank begins to sell, maybe a lot of traders in the world will sell also the bonds, and you have a financial crash. So that's good to stimulate, to boost the economy by giving base money a lot. But be careful. If a day the base money is changed in money stock, you could get inflation. And be careful. If you keep your bonds, if you decide to reduce the balance sheet by selling your bonds, you can have a financial crash. So be careful. And today, as an interest rates are negative, a lot of institutional investors buy risky assets to improve the return on their portfolio. Right? Do you have any question about that? That's very important because that's really quite a political question. You know, that's what do I do with my balance sheet? That's what do you think about that? Can you speak? Can you write a message? Nobody is writing. Okay. Nobody. Okay, I must organize some gift if you answer some gift. You know, it's if I have an answer, the lesson stops 5 minutes before 10 o'clock for you. 2 answers, 10 minutes. 3 answers, 15 minutes. I stop immediately if I have 5 answers. No, that's a joke. Oh, someone is writing. Let's say, okay, 5 minutes more. Okay, whoa, 2. Oh, good gift. Can you repeat my question? My question was just, do you have questions about what I explained during the last 5 minutes? It was not a technical question, just had you questions? Actually, no, sir. Okay. Is it clear for everyone? Maybe I will use something. It's okay. Inquiry. Okay, I have a question for you, and you will answer. Okay. First question. Do you learn something, or is it already known. Okay, you answer yes, no, or I don't answer. Okay? Okay. Okay, except one of you, okay? You seem to learn something. So tell me if you know already. It's okay. Thank you very much. Okay, globally, people learn. Okay. I have a question for the person who knows already. May I know if you work? Someone says no. Okay, said I don't learn anything because probably you know that's normal. But do you work in a bank, or do you know everything because you learned that before in a course here or in your previous studies? Could you answer? One of you told me, no, I don't learn anything. So could you just for my... Yes.
Excuse me, sir.
Yeah.
Actually, I have a question for you.
Yeah.
Regarding to the QE policy, actually, from last year until now, the US they issue a few package regarding to the QE, and right now they attend to apply the tapering
Yeah.
policy. So
Yeah.
my question is there any way to recall a QE policy, or there's the only way that applying the tapering QE to reducing the assets purchasing from the state bank?
Okay, could you maybe it would be better for me. I think I understood your question about tapering, but I would be sure to answer correctly. So can you just write quickly your question, and maybe it's better for me to be sure that I understood your question about tapering. Okay, so you send me a message and I answer immediately, and I see that people rightfully learn something except 1%, and I would like that the person here explain where he learned that already. That's very interesting for me. Is it in its professional framework or academic framework? It's very interesting. So and the lady who just asked the question about tapering, maybe send you your... Okay, there is any way.
Yeah, actually, I just sent in the message in the chat box. So can you please check it?
Sorry.
Actually, I just sent a message
Yes,
via
yes, I see.
the chat
Is
box.
there any
Yeah.
way to recall a QE policy or only via QE tapering? It's your question. Yeah, that's you?
Yes, that's correct.
Okay. Okay. Is there... okay, I raise the question for everybody. Is there any way to recall a QE policy or only via tapering way? To my mind, first, it's a situation which has never been known except in Japan, who implemented a monetary policy in 1990. But it's very, very new, this kind of thing. Never a central bank has his balance sheet multiplied by 5 in some years. So what we say at the Bank of France, I tell my story in our central bank, is that that's something that never arrived. So we cannot know what can arrive. And in our discussions, the only way to reduce the size is tapering. That it's selling, it's buying, first step, buying less assets than before, and then selling the assets. But what our discussion is, if the central bank decides to sell a small part of its portfolio of bonds. All the traders in the world, which are 25 years old, who are clever, who are well educated, would say, okay, if the central bank sells 1% of its portfolio, the price of bonds will move down. And as I am very clever, well educated, I know that my interest is to sell immediately the bonds before the other people sell. And as everybody in the world says the same thing, oh, the central bank will sell 1% of its portfolio, so all my colleagues in the world will sell, I would like to be the first one to sell. And everybody has the same behavior, mimetic behavior. So you have a crash. And our discussion is, we have to be very good in terms of communication. We don't have to tell people we will sell our bonds, because you have an immediate crash. And if you look at, I know from something I know, if you look at the communication of the European Central Bank by Christine Lagarde, never she speaks about tapering, about selling bonds, okay? Because she knows very well that if she says we will sell partly our portfolio, so market crashes immediately 1 second after. So to answer easily to your question, I think that it's the only way to reduce the size of the balance sheet, tapering, because tapering is just reducing buying bonds and then selling the portfolio. So I don't see any other solution. Okay, if you have another solution, please tell me. But I think that if you want to reduce the size of the balance sheet, because it's inflationary, you have to sell regularly with very good communication your portfolio. The person who told me I did not learn anything, can you just tell me where you learn that? It's very interesting for me. Do you work for the Central Bank of Vietnam, for instance? It would be interesting. Okay. Fine. You had already a monetary policy course. Okay. So, okay, I understand. So, okay. So maybe I will stop quickly about monetary policy, because I did not know that you have a course. That's very interesting what you are telling me. Okay. So sorry for because I did not know. Okay. I was nobody told me that you had a course. Okay. Okay. But okay. I hope just that we say the same thing. Okay, not different. But even we have small. I don't know the person who made the course on monetary policy, but it's interesting to get two views. Okay, independent views, because I don't know. Just okay. You remind. Okay, a lot of yes. Okay. I didn't have the course yet. Okay. Who is the professor who led the course of monetary policy? It's okay. You did not ever Richard Dutu. I don't know. He's a French guy or a Vietnamese guy or a Italian guy? That's very interesting. French. Oh, Dauphine. Okay. I work for La Sorbonne, which is in competition with Dauphine. Okay. But okay. So thank you very much. Okay. No, but Dauphine is a very, very. I know very well Dauphine. It's a very good university too. That was just a joke. Okay, so I know that you are very tired. Just I look if I have some other slides, and after we stop. Okay, for a World Bank. Okay, fine. Oh, good. You have very good professors here. Okay. I just look. Okay. Okay, I just would like to finish. Maybe we stop in 10 minutes, huh? Okay, 10 minutes, it will be okay. Okay. I would like just to show you one. Okay, that's interesting. Maybe it's January 21, but okay. Here, this picture. In January 2020, the Federal Reserve Bank held $5,400 billion of government securities, okay, through quantitative easing. So here you have here, okay. Then, okay, 5,000. That's here. Okay, federal debt held by, okay, here, okay, 5,400, and the level of the marketable public debt is 21,000 here, 21,000. Okay, that's the outstanding debt, public debt of United States. What does that mean? That means that the Fed today holds 25%, that is 5,400 divided by 21,000 of the US government debt. The Fed is now the first holder of US government debt. It's no more China. It's no more Japan. That's the Fed. And if you look at what happened in the Eurozone, the European Central Bank holds 30% more than 25 of the European government debt. And what is very important is that in Europe, we have a treaty which forbids, it's forbidden that the central bank lends directly to the treasury. In fact, what happens? Banks buy bonds issued by the treasury, and then the banks sell, as I told you, through quantitative easing, sell their bonds to the central bank. So indirectly, that's the central bank which finance the treasury, but it's normally forbidden. It's not direct financing, it's through banks. Okay, so I look if I have other. Okay, you will see by yourself. It's the same thing in the Eurozone. It's monetary base. Okay, monetary base. Mario Draghi has come here. Draghi. Okay. And here we are, 5,000 billion euro created. Okay, roughly the same thing. Okay, you understand. The difference between monetary base and money stocks, same thing. And I don't like Mario Draghi. Why? Transmission of our monetary policies through the banks has never worked better than today. In fact, as you see, he is responsible for the monetary base, and that's money stock. You cannot assert that you have a correlation between its policy, monetary base, and money stock. So when he says that the monetary policy has been very efficient, no, the money stock has moved a little, and the monetary base has moved a lot. So same thing as what we saw yesterday. Not yesterday, some minutes ago. So everyone is a little tired. So I think that you can look by yourself feature if you want. And maybe what you can, okay, we can stop now. And I propose that if you have time, because I understand that you have a lot of things, if you have time, please answer the question for next session. I think that's Monday. You have 5 questions. If you have time, you answer this question. Okay? Maybe I did not make the lesson about some of the questions, but okay, you try to answer. And next Sunday, we speak about the bond market, and after we speak about hedging with derivatives, that is using options, using swaps, using forward. I have a last question for you, and really after we stop, is normally I make a lesson next Monday on the bond market. Do you know, because I didn't know that you had a lesson on monetary policy, do you know a lot of things about the bond market? That is, are you really familiar with bond pricing, sensitivity, hedging a bond portfolio? And can we go quicker to derivatives? Or is it useful that I make one session about the bond market, bond pricing, bond sensitivity? Is it useful, or did you learn that before? If you learned that before, tell me immediately, and we go quickly to derivatives. Tell me. Okay, I have first. I want to go deeper in derivative. Okay. Okay. I want to go deeper in derivatives. I understand. It's just one session for bond. Okay, 2 different answers. Okay, sorry. After you have your dinner, don't forget. I don't forget. But I make a sondage. I like that, finally. Okay, sondage. Okay, let me just, I will ask you, how do we say? I don't know how to make another sondage. Okay, sorry. Okay, my question is, do you want bond 100% of the lesson? Not 110. That's A. B is bond 50%. C is immediately to derivatives. That's democracy, this course. Okay? Okay. Please, you answer. Ah, 50% is not bad. 100% is coming. Derivatives immediately. If you want derivatives immediately, you have to answer quickly. Answer C. Okay. Before getting all the answers, from a statistical point of view, you have 16 answers about a sample of 36, so it's roughly significant from a statistical point of view. That is, next Monday, we will get 50% of the session devoted to bond market and 50% beginning of the exciting part of the course, derivatives, and especially the options market. Okay, I wish you a very, very good dinner, sleep, I don't know what you want, dancing for people who are dancing tonight. I will make my voice better, I hope, next Monday, but I have course tomorrow. So see you next Monday. I was very happy to speak with you, and have a nice evening, and I hope you enjoy. Don't forget, I like that, you send me a message now before leaving, telling me it was complex, it was okay, it was marvelous, it was horrible. So it's interesting for me to know how you appreciate the course. Okay, don't hesitate. You can tell me it's horrible. Okay, that's not a problem. Okay, so you tell me before going to sleep or to dinner or to dance, and next Monday, 50% dancing or bond market and 50% derivatives. Okay, so have a nice evening, and don't forget to send a message with how you appreciate the lesson. Bye.